The AI headlines blur together. 100 billion here, mega campus there, record shattered again. The numbers stopped registering somewhere around the third consecutive week of bigger numbers. You scroll past them on your feed, think wow, and 3 seconds later you're watching someone make pasta. But you shouldn't scroll so fast. This year, big tech is on track to spend over $700 billion building out AI. That's 2.5 cents of every dollar the entire US economy makes. Jensen Huang calls it the largest infrastructure build-out in human history. Nobody's asking the obvious question, though: how are we paying for this? The answer starts with one number: $1.65 trillion. That's what 5 tech companies owe in obligations that stay off their balance sheets. The same 5 companies report about $1.35 trillion of debt on their books. The hidden pile isn't just bigger, it's way bigger. Take Meta. Their off-balance sheet debt is nearly triple what they report. Moving that much money out of sight takes a system. One with a name Wall Street has spent 20 years trying to forget. Summer 2007, right before everything broke, an economist named Paul McCulley from PIMCO stands up at the Fed's annual Jackson Hole Symposium and issues a warning. He's worried about a second banking system growing in the dark. Institutions that borrow like banks, lend like banks but aren't banks, no deposit insurance, no Fed safety net, no bank-style regulation. McCulley called it the shadow banking system. He described it as a whole alphabet soup of levered-up non-bank investment conduits, vehicles, and structures. If that sounds like word salad, here's the plain version. Company wants to borrow a mountain of money without the debt showing up on its own books. Solution: create a second company, a special purpose vehicle or SPV. On paper, they're completely separate. Different names, different bank accounts, most importantly, different debts. The SPV takes on the debt and uses that money to buy the assets. Then it leases those assets back to the original company. The SPV borrows the money and owns the asset. The original company uses it without the debt on its books. Picture opening a credit card in your cousin's name. You're the one swiping it, you're the one enjoying what it buys, but when the bank asks about your debts, your answer is technically zero. In 2007, the shadow banking system ran on piles of mortgages. Today, it runs on data centers. The AI build-out runs on financing machinery from the same family that broke the world in 2008. But the shadows aren't where this story starts. They're where the money comes from when everywhere else runs out. Let's look at where the money for the AI build-out is actually coming from and the family backing it. That same family that shattered everything back in 2008. And here's why that matters. What needs funding right now is the biggest infrastructure project humanity has ever attempted. No single source of capital runs deep enough to fund this alone. So big tech started knocking on every door, asking who else had money to spare. But first, they checked their own vaults. On paper, these companies look like the safest borrowers on the planet. PIMCO says the top-rated names among them carry net debt at just 0.04 times their earnings, the lowest ratio of any sector in the US. So the logic was straightforward. Let the cash machine fund the build-out. Then the machine started eating itself. For most of the last decade, these companies poured 40 to 50 cents of every dollar their businesses generated straight back into capital expenditures, reinvesting in themselves. This year, PIMCO estimates that number hits 94. Tech companies are running their entire cash engine to fuel the AI buildout. The vault isn't funding the buildout anymore. The buildout is draining the vault. When these companies ran out of cash to reinvest, they hit the bond markets at a pace we've never seen. From 2020 to 2024, the 5 biggest hyperscalers issued on average $28 billion a year in bonds. In 2025, the same 5 companies issued more than $100 billion, more than 4 times their average pace over the previous 5 years. Then 2026 happened. In just the first 5 months of this year, they've already borrowed another $159 billion. In 5 months, they've borrowed more than they had in the entire previous 5 years combined. The technology sector now accounts for nearly 18% of all U.S. investment-grade debt outstanding. It's gotten so extreme that the International Monetary Fund is now flagging it. Tobias Adrian, a senior official at the IMF and former senior vice president at the Federal Reserve Bank of New York, put it plainly. From a financial stability perspective, the major tech firms are starting to leverage up. When the U.S. market got saturated with tech debt, these companies went international. In February, Alphabet raised about $32 billion across 4 currencies in under 24 hours, including a 100-year bond that was roughly 10 times oversubscribed. Overnight, These companies became top bond issuers in currencies where they had zero bonds a year earlier. A bond manager at WTH Bones explained why big tech had to issue across all currencies. The US dollar market, the largest credit market globally, simply can't absorb it. The deepest capital market on earth can't handle what these tech companies need, so they had to look somewhere else. And somewhere else is where this stops being normal, because you can only stuff so much debt on your own books. That brings us back to the special purpose vehicle and the shadow banking system from earlier. One thing changed since 2008. Today, the shadow banking system hides right out in the open. Nobody catches it because of where it's hiding. It's tucked away in the footnotes of public filings, and the only people who read footnotes are finance nerds. Well, and me. Crack open those footnotes, and the first thing you see is how packed it is down there. I could spend an hour reading out names and numbers, and you'd still be nowhere near understanding how any of it actually works. So let's focus on one deal instead, the biggest one ever done. The blueprint every other deal copied, the largest project financing ever wrapped in an investment-grade bond. $27 billion, all stacked into a special purpose vehicle named after a New Orleans fried pastry. The entity goes by Beignet Investor. It's the shadow banking machine from earlier but running for real. One job, own a data center campus called Hyperion, a multi-gigawatt site in Richland Parish, rural Louisiana. Hyperion belongs to Meta. Meta announced it. Meta designed it. Meta built it. Meta runs it. Meta is the only tenant it will ever have. But that $27 billion in debt that paid for Hyperion, it sits on the pastry's books. Here's the mechanics. Blue Owl Capital, a private investment firm, creates Beignet Investor and puts up 80% of the equity. Meta chips in the other 20% and signs on as the building's only tenant. Then Beignet starts borrowing. It issues $27.3 billion in investment-grade bonds. The bondholders, some of the biggest money managers on earth like BlackRock and PIMCO, wire in the cash. Beignet takes that money and constructs Hyperion. Then the final move. Meta moves in and starts paying rent. That rent is what repays the bondholders year after year, all the way out to 2049. So it's Meta's data center, Meta's machines, Meta's engineers inside, but legally Meta owns just 20% of it while Blue Owl holds the other 80%. The reason comes down to one phrase in the accounting rules. At 20%, Meta isn't the primary beneficiary of the venture, and if you're not the primary beneficiary, that $27 billion in debt isn't your debt. It disappears from your balance sheet, legally speaking. But there's more tucked into the fine print of Meta's own filings. On page 106 of Meta's annual report, one sentence buried at the bottom reads, "We have provided residual value guarantees with an aggregate threshold of approximately $28 billion that decreases over time." If that doesn't land for you, that's fine. I had to read it 4 times before it clicked. Basically, Meta is guaranteeing the building. If Meta ever walks away and Hyperion is worth less than a guaranteed floor, Meta covers the difference. Say the campus drops to $20 billion against the $28 billion floor. Meta writes an $8 billion check to make the bondholders whole. So to Wall Street, Meta says, "We don't own it. We didn't borrow the $27 billion. This isn't our liability." To the bondholders, Meta says, "Don't worry. If this thing loses value when we leave, we've got you covered for up to $28 billion. It's the same thing. Meta just tells 2 different stories. Then there's the cherry on top. The bonds Beignet issued to finance Hyperion mature in 2049, but Meta's lease doesn't even start until 2029, and it renews in 4-year chunks. So you have a 24-year loan sitting on top of a 4-year lease. And remember what this building is. A hyper-specialized supercomputing site built around Meta's own hardware in rural Louisiana. If Meta ever walks, the bondholders are stuck holding a very large, very specific building for the next 2 decades. But Beignet didn't stay as a one-off deal. It became a template. Let me tell you about Project Sophia. No, that's really what they're calling it. Last week, BlackRock launched the follow-up to Project Beignet, Project Sophia. More than $12 billion in bonds backing Meta's newest 1-gigawatt AI data center in El Paso, Texas, with JP Morgan and Morgan Stanley handling the sale. Same structure as before, same 80-20 split, just a different pastry name. On its own, 2 deals is just 2 deals, doesn't prove much of anything. But here's where it gets unsettling. Look at the last 9 months. The numbers show the off-balance sheet debt pile across those 5 companies has ballooned roughly 8 times larger since 2022. The law firm Quinn Emanuel tracked more than $120 billion moved off balance sheets in under 2 years. Moody's found big tech signed contracts pledging nearly $1 trillion for future AI data center leases. Yet over $660 billion of those obligations sits completely invisible on their main balance sheets right now. Morgan Stanley puts the total off-balance sheet exposure across the industry at around $1.8 trillion. So this isn't just meta, we're seeing it across the whole sector. And here's why it becomes a deeper systemic problem. It's the same small circle of lenders showing up on every single deal. When 5 borrowers share one structure funded by one handful of lenders, the risk stops being diversifiable. It's the same bet written 5 times over. The last 2 times financing structures standardized this quickly across an entire industry. Telecom vendor financing between 1998 and 2000, and mortgage securitization from 2004 to 2007. A lawyer at Quinn Emanuel, someone who spent years handling litigation that followed 2008, watched this unfold and described it with just 2 words: déjà vu. So there's your answer to the question we started with. How is the largest infrastructure build-out in human history getting paid for? First with cash until the machines started eating 94 cents of every dollar, then with bonds until even the deepest capital market couldn't absorb them anymore. And now in the footnotes, where that hidden pile of debt has quietly grown larger than the public-facing balance sheet totals. So where does that leave you? I've been buried in these filings for weeks, and honestly, I can't tell you how this plays out. Every week the story gets stranger. But I can tell you what needs to happen because this isn't really an investment anymore. It's the biggest wager in history and it rests on 4 legs. Leg 1, revenue doesn't just grow, it multiplies. Right now, AI brings in around $110 billion a year against more than $700 billion in spending. Leg 2, returns stop falling. Industry analysis shows the return on every new dollar the cloud giants deploy has dropped from around 40% toward 20, with forecasts heading toward 10 if the spending continues. Leg 3, the borrowing window stays open. Morgan Stanley puts the total build-out at roughly $2.9 trillion through 2028. The company's own cash flows cover about $1.4 trillion of that, leaving a $1.5 trillion gap between the plan and the actual money. And leg 4, the grid handles all of it. The biggest power market in America is already stuck at its price ceiling, but that's a whole other video. None of this AI stuff is hidden. It's sitting right there in public filings, auction records, analyst reports. Nobody reads any of it except the nerds in Patagonia vests. That's what this channel is. I do the reading, you get the parts that matter. When you pull back and see everything that has to line up for AI to deliver, it stops looking like investing in a new technology. It starts looking like a parlay, 4 legs stacked on top of each other. Every single leg has to hit or the whole thing falls apart. If you liked today's video, please help us by subscribing to the channel. Hit the like button and tell us what we can cover in the next video.